I mean, in terms of recent activity in the portfolio, some might not see it as that recent because you're going back not 6 months but 8 months, and of course in this business that's a lifetime for some. But really in the second quarter of 2019, I think some of the key decisions were made in our portfolios. And I highlight in particular what was quite a contrarian decision, I think, at the time, which was to alight upon capital goods, selected capital goods. It can only ever be selected because we're a focused portfolio. But selected industrial capital goods and indeed semiconductor names at a time when the narrative, notably in semiconductors, was not good. The story wasn't good. Now, I'm very used to the story not being good in Europe. That's always the story. And here we are at all-time highs. It was ever thus. But that was the key, I would say the key moment or key decisions, they came in two waves. One, January in 2019, we decided all banks we should sell. Two, late spring, early summer, building up in semiconductors and industrials. That really was the 2019 sort of key decisions. More recently, so recent weeks, and there have been one or two new names coming into the portfolio. I'd rather not speak about them just yet because we may not be finished purchasing them, but we are alighting on one or two new names going into the new year. It's not 6% of the NAV. It's 2 or 3% of the NAV that's changing. It has meant gearing's gone up to about 5% as we speak, but that itself is also fluid. So the reason I've talked a wee bit about the investor, certainly the sterling investor, in European equities sitting here at or around all-time highs. I talk about that a bit, not to say, oh, haven't European equities done ever so well, or haven't we done ever so well? Not at all. It's more to sort of, in a sense, juxtaposition that against the narrative. And between Christmas and New Year, because I'm a very cheery person, I was reading an article by a UK investment periodical that actually had a headline something like "Signs of Hope for European Equities." Really? Has this been a bear market? Not at all. The last decade in absolute terms, it definitely hasn't matched US equities, and I guess the comment is relative from that magazine. But actually, let's look over 5, 10 and more years than that, taking a reasonable time frame, 10 years. If you can't go that far, take 5. Okay, take 1. It's been good. The sterling investor has done very well out of European equities. And yet the narrative remains gloom and doom and geopolitics. And I have said for the 30-odd years I've been involved with this, ignore the geopolitical noise. There's always loads of it. The other thing is, can we please accept that every single year you are likely to get at least a 10% correction in equities? It's what they do. And in other words, it's about staying the course. And I guess that brings me back to the question that was asked about, so what about this year? Because everybody, well, what about this year? And I find it mad, actually. Nobody's got a clue about what's going to happen this year or next year. It is therefore guesswork. My guess is, in this US presidential election year, and I look a wee bit at history and what tends to happen, whatever, I don't think it's as strong as last year, as 2019. I really don't. I think if we make high single-digit returns to investors, I think that's going to be good. I don't think it's a down year, but what do I know? It might be. I've no idea where currencies are going to go, so your 5, 6, 7 or 8% return could get wiped out by sterling strength. No idea, but I think we have another positive year. That being said, I think the easy money has been made.